Jenny, start with you. Your clients, obviously, I got your note that you sent out to clients yesterday. Thought it was very measured, very calm. We look like we're going to fall again today. What are you advising your clients and our viewers to do right now?
I advise everyone to stay the course. And I know that's the most boring, routine advice I can possibly give, but it's real. So I've been down on the Eastern Shore of Maryland for the past 2 days meeting with clients. And here's the conversation that we're having, which is, look, the market's down about 22% year to date. Let's say it gets worse. Let's say we trade to a multiple of 14.5 times, and that brings the market to down about 32% on the year. All right, most of the work's already been done. I had a meeting with a client yesterday who actually was really surprised by a portfolio that I do not manage and how much it was down. It was a combination of high growth and bonds. And both of those have really worked against her. And she said, what should I do? I said, it's too late to do anything now. What are you going to do? The bonds are down 12% already year to date. That's for investment grade. The growth stocks are already down. At this point, most of the damage is done. So I don't think it makes sense to start to get aggressive and pivot now. Now is where you check on what you own, you stay the course. Okay, sure, if you have some real dogs where there's never going to be recovery, fine, maybe you get out of those. But for the bulk of the portfolio, you grit your teeth, bear it, and get through it. And you remember the fact that you've made more money over the past decade than you ever expected to make. And you just kind of put your head down and keep moving forward. It's boring advice, but it's absolutely the right advice.
Yeah. We'll call that BBI, boring but important, because you're right, longer term, you want to buy low. We look for discounts and everything else in our life. I don't know why we wouldn't look for discounts in stocks. All right, Dana, talk to us about this macro economy. I don't know. I don't know what to believe, Dana, because with my eyes, I'm seeing people spending. Every plane is oversold. I don't know what to think. Now we're hearing recession is imminent. What's your take?
Sure. There's a difference between what's happening now and what's probably going to happen in the future. Right now, you're absolutely right. Consumers are spending. Even though goods spending in yesterday's retail sales report was weak, we know that people are shifting to buying services, right? They're thinking about going on vacation, and they're actually going. They're going to restaurants. They're going back to sporting events, and they're engaging in those types of spending. And also, when we look at our consumer confidence measure, the current conditions gauge is fine. Consumers are okay. Why is that? Because they're working. They have jobs. They're seeing their wages rise. However, looking ahead, after yesterday's 75 basis point hike, many of us economists are saying, well, look, this is probably going to elicit a recession. It may be brief, it may be shallow, but a recession nonetheless if the Fed really raises rates close to 3.5% by the end of this year and then close to 4% at some point next year. That's very aggressive. That's raising interest rates into restrictive territory. That's going to slow the economy.
And Dana, I'll do a quick follow-up with you because this is in many ways a global inflation story. It is a supply-side driven inflation story. And I kind of only half joked the other day that with all due respect to Jay Powell and the Fed, unless they want to drill an oil well or start captaining a ship filled with goods from China, I don't know what they're going to be able to do about inflation. This is not a normal, just simply monetary policy issue, is it?
No, it isn't. And the thing is that there are two types of inflation drivers. There's demand drivers and supply drivers. On the demand side, yes, there's still pretty strong consumer spending. People are working. Many people are still looking to buy a house. The Fed can address those demand drivers by raising interest rates. The Fed can't address those supply drivers that are lifting inflation, things that you mentioned already. Things like the war causing global commodity prices to rise, or China shutting down over COVID, and China's kind of a major manufacturing hub and supply chains.
You know, Jenny, you ever listen to sports radio? You can admit it if you do. It's all right. You ever?
I don't.
Well, if you did, you would know that everybody now is a gambling expert, because sports gambling is booming. And just bear with me here on this analogy. Everybody out there is like, well, you got to put $100 on the Bengals minus 3.5. Every single person. And I feel like the Federal Reserve is the sports radio guy who went 7-44 in his locks of the week last year, but is still asking you to follow his bets. Because I heard Jeff Gunlock on CNBC yesterday basically saying, Jay Powell has no credibility left. These people have got it so wrong that, why do we listen to them? But because we have to, because they're moving markets. Do you trust Jay Powell and the Fed?
Yeah, I actually do. And I think it's overly cynical and just kind of attention grabbing to be too negative on the Fed. Here's what we know about the Fed. They're really smart. You're really smart, Brian. I'm really smart. I don't get it right all the time. You don't get it right. Nobody gets it right all the time. So you know what you do? You trust people who are trying their best, who have a lot of information, who have more information than you do. I think they did the best they could. And I think this is one of the things that I like about the Fed. There's consistently the Fed leadership, in my opinion, has been the least partisan agency that I've experienced, and I think that they try their best. What I love about Jay Powell is that he does exactly what he says, which is he says, above all else, and you talked about this earlier in the show, I will remain flexible. And that's what I want, right? I don't want him to dig in so hard that he can't do something. And people say, oh, he did. But you know what the reality is he saw the CPI numbers last week, and the Fed said, oh boy, whoa, this is worse than we expect, and we're going to be flexible. And that's what I do as a portfolio manager. That's what you do in your job. You adjust to the news that's coming your way, and we're trying our best. So I think you do listen to the Fed. I think you do hope for the best. I think it's overly cynical not to, and frankly, I think it's unintelligent, not to say this is an agency that's trying its best and leading us. And the truth is, they've done a pretty darn good job, because here we are with. Sorry, go ahead.
No, I was going to say, and I'll go to Dana on that just because we're running out of time. Okay, we're going to take that view, and I would agree with a lot of what Jenny had to say, Dana, because there is no history book for what happened. The last pandemic, 68, 1957, 1918, we didn't have a global economy. We didn't have to rely on shipping from around the world and COVID lockdowns and the Ningbo export terminal in China. There was no playbook for this. But do you trust the Fed going forward?
Actually, I do. And I think markets also trust the Fed. In fact, after yesterday's action, stock market rallied. And that's basically because people believe the Fed is credible. And that's really one of the three things the Fed is trying to address, making sure that they bring down actual inflation, make sure that inflation expectations remain anchored, and that markets and consumers and businesses see them as credible. So I think the Fed is winning at that.